All right. Welcome, everybody. This is AG with the Real Acquisitions. And today on the show, we have a good friend and a pretty well-known figure in the Houston and Texas investment circle, Michael Plaks, the numbers man. So, Michael, welcome to the show.
Hey, thanks, AG. Good to see you always, and thanks for inviting me.
You bet. This is the YouTube channel of Real Acquisitions. From time to time, we invite some movers and shakers in the real estate community.
But not today.
People that can add value to the real estate investment community in general. And we just like to have a candid conversation about some of the things that they're doing and some of the services, maybe products that they have that can add value to various investors' lives. So again, Michael, thanks for joining us this morning. And why don't you begin by telling a little bit about yourself? I know you, of course, for all these years that I've been seeing you on the rich club circles, lifestyle circles, and all those clubs. But good to have you with us. So why don't you tell us a little bit about yourself?
The reason you see me there, AG, because all my business is real estate investors. My only customer base is real estate only investors, and I've been doing it for close to 20 years right now. I'm an accountant, as you obviously know, but what we do here in my office, we prepare tax returns for investors. We do consultations on real estate business, on setting up entities, things like that, and also a service that I hope nobody needs, but we do provide it, helping with IRS problems.
Hopefully no audits.
Yes, hopefully not. That is right.
So, obviously as somebody who owns and manages my own real estate, I absolutely understand the value of working with a CPA that specializes in real estate. But why don't you illustrate, or why don't you maybe dig a little deeper as to if an investor is looking to bring a CPA on board, why is it important to work with a CPA who specializes in real estate?
That's the same question if you ask why is it important to bring any other specialist. You can do everything yourself. Why is it important to have a doctor? To watch over your health. Accountant in this business watches over your financial health. So kind of the same idea.
Right. No, what I meant is why a real estate expert in your CPA? Like a lot of people say, I already have a CPA. I've been working with a CPA for many years. Why do I need to work with a CPA that specializes in real estate? Like, what are the nuances in our line of business that make your services valuable?
I see. So how long is our conversation?
As long as we can make it entertaining and interesting, Mike.
Well, on the back of my business card, which, give me a second, I'll actually, okay, here is an actual quote. Can you see it here? Read this. Okay, on the back of my business card, it says, before, I pay too much taxes because my CPA does not understand real estate. After, wow, I wish I hired you several years ago when I bought my first property. So that's the essence of that. It's just like in any field, there are general specialists that know enough about various things, and then there are specialists in a specific area that are very in-depth in a certain specialty. It's just like if you are taking a contractor. Okay, you can take a general handyman who can do everything. But if you have an electrical issue, you want a licensed electrician. I guess that is somewhat similar in this business. I do a lot of second opinions. People bring me tax returns prepared themselves, prepared by professionals, anywhere from H&R blockchains to CPAs. And we find a lot of issues which cost people thousands of dollars stemming from not understanding how it works. If you want to take an example, probably one of the simplest to bring is when you have rental property, one of the big deductions is depreciation, which can be thousands of dollars literally in your pocket. I see returns where depreciation is not taken at all, taken incorrectly, or even if it's taken correctly, they can come to us and we maybe can optimize that and squeeze a significant amount of extra money out of that. But it obviously requires knowing that specific area in and out.
Wow, that's shocking. Just to hear that as a landlord, you for you to leave one of the most important benefits of rental property, which is depreciation, to leave that on the table is amazing. Now,
A lot of people do, yes,
yeah. To
unfortunately.
build on that, I've often heard you speak. Of course, you're a very well-known speaker. I've heard you speak at many circuits. You were obviously invited at many forums. I've heard you speak often about the crux of real estate CPA business is good bookkeeping. Can you illustrate on that, or can you go deeper into that?
Oh, sure. Of course, you asked me to talk about my favorite subject anytime. Well, question that I get asked all the time by investors, by colleagues is, okay, what is the most important way investors can save money when they on the tax side of the business? And when the question is asked, what is assumed that I could share some kind of a loophole, some kind of a secret strategy, let's form a special type of company, let's do something very sophisticated and unique in order to save on taxes. But what I really find out is that the answer is as simple as it is and as boring as it sounds, which is bookkeeping. Example of that, which I would like to cite. Let's say that you are hiring somebody for a simple project. And let's take painting as an example. So you found this contractor and you were able to bring him down from his 2,000 quote for the job down to, let's say, 1,500. Most clients of mine, and probably a lot of people you know, will spend a good amount of money interviewing different contractors and will be pretty happy at the end of the day saving $500 on a 2,000 job. Agreed?
Absolutely.
Right. Okay. And then they pay that guy in cash, didn't keep any kind of record, any kind of receipt. They come to me to prepare tax return. The 2,000 gets done. Guess what? You just threw out the same $500 that you saved by careful negotiating and spending hours on that. And you threw it completely away, giving it to Uncle Sam, which does no good to anybody literally. And all it would take to avoid that is have a system for bookkeeping. So that's why I'm saying is that that's the simplest. It's just like when you're talking about fixing a house. You don't start picking paint and doing sheetrock repairs before you have your foundation leveled. So we have to have foundation first. Foundation in my business is bookkeeping.
And of course, you know this as well as I do, that most investors, being small investors, they just don't have bookkeeping at all.
Yes, I do. I do know that, unfortunately. The funny part is, and I'm sad to say that usually the bigger the business is, the worse bookkeeping practices are, which is very sad. It should be the other way around. But that's what I see over and over again. Some of the biggest investors in town come to us, and the first thing we have to start is get out of the mess that they put themselves in by not having a system.
QuickBooks, is that your recommended software? Is that what you see most common out there?
Well, you asked two questions. Is that recommended or is it most common? Okay, most common, absolutely, yes. That is universal type of software which everybody knows about, everybody can buy at office supply store, even at Walmart. So yeah, sure, in that respect. But that name of that software is misleading. It says QuickBooks. The only quick thing about it is you can very quickly mess it up. And that's what people do all the time. They get that it looks simple, but it is not. And the most dangerous part, that particularly in real estate, QuickBooks is absolutely unsuitable for bookkeeping for real estate out of the box. You must customize that. They have versions of QuickBooks customized for different industries. Like they have a contractor version for QuickBooks. So if you are a contractor, sure, that is fine. If you are a realtor, yes. But if you are a real estate investor, buying, selling, renting properties, you cannot use QuickBooks out of the box effectively. It will create unusable collection of numbers. You will spend a lot of hours, and unless it's customized specifically for real estate, which I repeated 5 times now, then nothing good will come out of that. Just a big mess of numbers. That's what we see all the time. Unfortunately, even if you take it to professionals, I took, like that was about a year ago, I put a 2-day seminar teaching real estate bookkeeping, specifically real estate bookkeeping. And
that was in January of 2014, a very popular class. We heard great reviews of that class.
Yeah, thanks for mentioning. Yes, so on that class, what I did as part of that seminar is we took examples, and I showed examples of reports done by professional bookkeepers. I'm not talking about, you know, somebody who put a green sheet ad, you know, for $10 an hour, I can help you with your books. I'm talking about certified QuickBooks advisor, which is like top-notch bookkeepers that you can find to do your business. And that would be excellent if you're not a real estate investor. For real estate investors, these people who were paid literally $20,000 more than that for the annual service by my client. Is that IRS?
I hope not.
So, and people would spend $20,000 on a bookkeeping service and receive totally unusable result from that. So we would have to throw it away and start all over, despite the fact that it's done by professional bookkeepers. So real estate is a very unique field, which requires very much specialized approach.
Very interesting. Any common mistakes that you see investors, especially landlords, making in bookkeeping?
Absolutely. You said any common one. Well, maybe a couple dozens of them. Number one, probably the most glaring, the most troubling mistake there is everything that you record in QuickBooks or in any other bookkeeping system and you have rental properties must be allocated to specific properties. Whatever you spend has to be attached to a property. So if you have, let's say, 4 properties, you would literally need 5 different places. 1 per property plus 5th will be 1 for generic expenses, overall business overhead, things like marketing, for instance, you know, lawyers and accountants, supplies, computers, that kind of things. Membership in real acquisition.
That's not an expense, that's an investment.
Exactly. Good point. So that investment has to be recorded in a generic column. But then things that are specific to properties has to be clearly assigned to a property. And that's where most of bookkeepers fail. They don't realize, because in other types of businesses there is no such thing as allocation of expenses to a specific sub-accounts. So that feature is where the most problems occur.
Yeah, I went through that. When I set up my QuickBooks for the first time, I was like, oh my gosh, there's no generic way. So I use the class system in QuickBooks to designate different properties.
Classes is the exact feature that you would need to use. Yet I find a lot of bookkeepers who never even heard about classes, much less use them.
Well, I'm learning from the best like you, my friend.
Thanks.
Okay, so let's transition on. So obviously, rental properties, good bookkeeping, great values, services that you guys can provide. What else? What are some of the other things where you believe real estate investors need a specialist like yourself?
Specialist is needed in 2 situations, like, you know, any kind of specialist, to prevent problems or to solve problems. So we obviously try to prevent.
Absolutely.
Okay. Now, bookkeeping will be what we just talked about on the side of preventing problems. Okay. On a different side, like let's talk about completely different set of problems. Okay. And when I say problems, problems may not be the best way to describe it, but let's call it missed opportunities. What I see a lot of times, and that specifically has to do with real estate investors, we tend to look at certain things which are easy to understand, and everybody can relate to that. You look at something, you make a deal. What's number one thing you are paying attention to?
Profit
Right,
margin
price,
in and
right?
out.
What other? AJ, what did you say?
I said yes, price, because that ultimately impacts my my bottom line.
Okay, so when I look, for example, at closing on a HUD statement, okay, the two places where most investors look first is very top and very bottom. At the very top, we see sales price. That's obviously important number. At the bottom, we see what I have to bring to closing,
Cash to close.
what I take home if I'm selling. Okay, those are the two numbers that matters. What in between on that HUD is another maybe anywhere from 10 to 50 different numbers, gets confusing, and a lot of people glance at that and push it aside. In my book, that's a big mistake, because every time we take, not every time of course, but a lot of times we analyze those statements, and I start asking my clients, what about this, what about that, what I get is, wow, really, I never paid any attention to that. And what I'm talking about can cost you thousands of dollars literally by not knowing what is there. Example is, you are looking, you are overlooking something like an insurance, how insurance premium is recorded on a HUD statement. If it's recorded in the wrong place, and that I see over and over again, you can easily end up paying twice for the same policy, and nobody would notice that until they come to me and I look at the HUD statement. Now, you just threw money out of pocket and nobody notices that, because that would be rolled into the loan. If it's rolled into the loan, it doesn't cost you at closing, but it still costs you eventually. And people let these things go without noticing. That happens when you look at fees charged for financing. That happens when you look at a lot of other things, such as credits, prorations, and things on the HUD statement. In fact, I got so
Badass at looking at HUDs. Is that
oh,
what you're saying?
that's not what I was looking at. I was saying, like, I was looking like distressed with seeing that over and over again. But I'll take your description too. That's a good one to put it. Okay, so basically, we even decided to put up a little class specifically talking about reading HUD statements correctly and saving yourself thousands of dollars by analyzing HUD statements, understanding what is there, understanding what costs you money. So we will have that class coming up pretty soon, actually in December.
So that'll be a great class. As a matter of fact, I would imagine that if you don't know, or if you're not analyzing HUD, you're also leaving a lot of money on the table as far as deductions go, because many of those expenses on the HUD are actually deductible, like document preparation fee, for example, right?
That is partially correct. Okay, you're absolutely correct as far as that you would be missing tax deductions too. As far as talking document preparation fee, etc., that can get a little complicated. So
okay, the topic for we'll leave it for your class.
Right, the one you specifically mentioned, for instance, it's not deducted at the time of purchase. It will have to be added to the cost of the property. But that goes into.
I didn't know that.
Okay, so you need to take the class then.
I absolutely.
Okay. The purpose of the class essentially is to not as much on the tax deduction side, although that is very important. I'm not talking right now about tax preparation, because if you take the HUD statement into into specialized office, people who know real estate, somebody like us, they would take good care of the hard statement. They will take pieces that are important and deduct them. What I'm talking about is different. Before you come to tax preparation, during the closing, you can leave a lot of money on the table, literally. I'm not talking tax deduction. I'm talking about your costs that you don't realize are included on the HUD and often included incorrectly, because either the people who were completing that are not well trained, or occasionally, I hate to say that, but occasionally it's even done maliciously. We have seen things that appear to be done not in good faith. Yeah, but you also need to know how to spot them.
Absolutely. That you know what tremendously goes back to a different topic, which is keeping working with escrow officers that you know and you trust.
Yeah, one of them tried to call you and complain about my statement.
Okay. Now I know that one of the most important strategies that investors use in their arsenal is owner financing. I'm big into owner financing. I buy a lot using owner financing. I sell a lot using owner financing. And I know that IRS, unless done right, can really take you to the cleaners if you're not knowing what you're doing. Can you talk a little bit about that? Because I know owner financing is you're probably one of the premier experts in that area in terms of structuring it correctly. Can you talk a little bit about that, Mike?
Sure. You happen to touch upon another favorite topics of mine, and favorite not because I like the consequences, because I feel it's my mission to warn and continue warning people to avoid this very dangerous mistake. I try to talk about it at every opportunity, and that has to do with owner financing flips. Just recently, I actually wrote a blog post, and I actually hope that most of Houston investors know about my blog and read it, because there are a lot of information like that specific to real estate taxation. So what is happening there is you can owner finance, and I'm talking about selling. You mentioned a second ago you are buying with owner finance and selling owner finance.
Yep.
We're talking right now only about selling. And if you have a rental property that you sell with owner financing, and the whole idea of owner financing is you receive some money up front and then you receive payments. So it takes years before you actually get paid on the deal. And as much as we can use
unrealized gain.
Yes, yes. And as much as we don't want to use the word fair when we talk about taxation, but a fair approach would be pay taxes as you receive payments, which is more or less what is happening when you are selling rental. You are selling rental, you receive partial payment, you pay taxes on the debt. It's more complicated than this, but generally speaking, you can think about it this way. So you get money, you pay taxes on that. Get more money, pay more taxes, and so on. And people assume that the same thing would happen if you flip a property and owner finance a flipped property. And they are very much shocked that it does not work like that at all.
So let's break it down. What you're specifically talking about is I purchased a property using owner financing, and now I am selling the property via a wrap.
What your example, in fact, is even more complicated.
Okay, so let's talk about your example. What are you talking about? Purchasing with seller financing and then selling it retail, so I'm paying off the seller or the original seller?
Let's take buying with owner financing out of your example, if I may.
Okay.
Let's say that you bought it cash.
Okay.
For simplicity. Because yes, wraps has its own set of complexity on top of what I'm talking about. Okay. But let's say that you bought it cash, selling owner financing, selling with owner financing, which at that point a lot of people assume that if you sell a flip on owner financing, that it would also look under that so-called fair model. You got down payment, you pay taxes on the down payment. Next year you get 12 more payments, you are paying taxes on those 12 more payments. And in reality, that's not at all how it works. What really is happening is the IRS calculates your entire profit at the moment of sale, even though you didn't get your money yet.
Even though you've not realized it.
You're right, you did not get that money yet. All you got is down payment. The IRS doesn't care. They say they will figure out your entire future profit and tax you on that profit today. And when we do numbers, what often is happening is that tax liability that first year, what you owe to Uncle Sam, is greater than what you collected as a down payment from your buyer in that first year. You end up upside down, actually, having to reach into your pocket and make up the difference in the first year. Completely
That's interesting.
unfair.
I've always heard that IRS recognizes the concept of installment sales. You're saying that's not true?
It is true in the case of rentals. That's where the confusion is. If we are talking about a rental property, a house that you had a tenant in for a few years, and now that tenant wants to buy that house from you, and they still cannot get conventional loan, so they come to you and you agree to owner finance house to them. So there you can deal with what you called correctly installment sale, which is paying taxes as you receive money. Once again, that's rental property only. But if it was a flip that you bought 3 months ago, fixed up, and now put on the market, and you're trying to sell it with owner financing, that's when the real problem happens. And it's a very severe problem.
So you have to pay the entire unrealized gain on your basis. So I guess one of the most important things that as an investor I'll have to think about is how big my down payment is. So at least I'm not on the negative in the first year. Would you agree with that?
Yes. You hit it exactly right. So number one consideration if you have to do that will be get at least big enough down payment, so at a minimum you would be covered for your taxes. You may not generate a lot of money that year, but at least you will not have to reach into your pocket to pay taxes. Yes, that's a must. But in order to do that, you need to know how to calculate that. There is the next stage, like after that. So can something be done to actually reduce the amount of these taxes? I get that question a lot. People saying, yeah, we've heard there is the problem. We know if we sell it with owner financing, we will owe through the nose. Can something be done about that? The answer is yes, but it's not simple. There are some very complicated, well, very may be an overstatement, but fairly complicated strategies that you can do on the advanced side, how to structure your owner finance deals in order to alleviate that problem, to not have to face that tax hit in the year of sale, even with flips. Yes, it's possible, but it's not common knowledge and it's not simple.
I see. Okay. And I understand that you're putting together an event to go exactly into those strategies. Am I correct?
Yeah, I guess you saw that on Facebook. Yeah, Houston Investor Group on the Facebook. Yes, we put an ad there. This coming Saturday, we are teaching how to structure owner finance deals. And that's not only for flips. I gave you one example, which is the biggest issue in owner financing. But everything you do, buying with owner financing, selling with owner financing, reps, you know, all of those situations have opportunities to optimize taxes on the same deal. And what I feel very important here is this: you are going to make the deal anyway. You are buying and selling, you made your decision. Why pay more on the same deal when you can save money and significant money by simply restructuring the deal and applying some advanced strategies? So unlike, for instance, HUD class, I earlier mentioned that in December we will be teaching a class how to read HUD statement. This one about structuring owner financing is geared towards more advanced investors, those who specifically deal with owner financing and want to take it up to the next level and save money by restructuring those deals.
Sounds like a wonderful class.
Yes, I'm looking forward to that. That's the first time we are going to teach those strategies. I showed them before privately to some of my clients, but right now we are trying to spread that knowledge a little wider.
So where can I go, Mike, to get some more information about that class?
My website, michaelplaks.com.
Okay, so let me just quickly, is there anything else about the class that you possibly want to share with us?
I can share a lot about that class, but oh, thanks for bringing it up. Yep, that's exactly.
Go here.
Yes,
you can go to this class and you can see there's a lot of information. One of the things I love about Mike's website is if you go up to the top, it has a wonderful blog. I know I'm a regular reader of this blog.
And if you move one position to the right under Stay Informed, there are classes and seminars, second choice from the top. Yep, right here. So here you will see detailed description of various classes that we do, schedule, registration, and all of that information. Picture of a finance class, that's the one. And then next is HUD statements, and all the other classes that we are doing in the near future is there.
Perfect.
Thanks for showing that, Agent.
Sounds like, you bet. Sounds like a lot of fun, Mike. So, Mike, any other parting tips?
Well, if we talk about parting tips, is right now is the end of the year. There are certain decisions that investors will need to make by the end of the year. For example, whether to pay property taxes in December or in January, whether to close on a deal in December or January if the closing date is movable, and things like that. As a matter of fact, tonight I will do a presentation about it for the members of the Real Estate Investment Club of Houston. It's tonight at the Reach Club, but for the members of the club. For if you're not
tonight,
go ahead.
When Mike says tonight, he's talking about November 17th. This interview is going to be on YouTube, Mike, for 15-20 years, so people may not know what we're talking about. So November 17, 2014 is when Mike is talking about, and of course the event that Mike is
talk again in the next 15 or 20 years. But but other than going to the presentation, there will be a blog post which I update every year about some tax planning tips for the end of the year. So I would encourage everybody to check out my website and see what we say on our blog about it, because this is the right time to make some very important decisions.
Awesome. So guys, we appreciate everybody joining us this morning. In the email, I will be sending an email out with this video to everybody, along with some of the things that Mike covered. In that email, you'll also see a link that you can use to get access to Mike's class. But Mike, thank you, wonderful. It was great as always talking to you, and I'll of course be seeing you around on the various circuits that we will be at.